So given all this, all of the the difficulties in the market, slow growth, are you surprised that sellers are still getting their price? As it appears that some are, and like what does that tell you about investor demand for multifamily?
It's hard.
At least in the Midwest and the markets that
In
we're
the
in.
markets we're in, it's hard because like they're getting their price, but you and I have conversations like, okay, what are they trying to solve for? And I think it's like, what are they trying to solve for versus what we're trying to solve for? Because like, if I went through and I put the price that I know some of these have gone for, and I brought that to you, like it'd be like a 9 IRR, and we would never raise money for that deal. Like it just wouldn't happen, and so it's that's why I think the biggest difficulty is it's like, okay, where can I find that deal that hits the returns that we need?
So for that group that's doing the 9 IRR deal, is it because 9 IRR is all that they need, or are they speculating, or are they being more aggressive on their assumptions? And so in their mind, it's a
It could be that,
12,
or
13, 14,
and there's
15.
some people that like it kind of depends on if you're raising money or if you have your own money. And I think even your own money, it's different. Like, do you have a fund? Are
Yeah.
you a family office, or are you raising money? Because I think especially with some of those family offices, they're in wealth preservation mode. So for them, a 9 IRR on something, yeah, I don't need the money today. Cash flow
Low
is
leverage,
nice.
especially lower leverage,
Yeah,
plenty of
but it's
margin
a
for safety.
but it's a nice store of value,
Yeah.
and so that they're willing to buy that prime location that maybe a little bit lower cash flow right now, but is going to do well in the long term. And if they hold it for 15, 20, 25 years, they're an IRR on a 25-year deal that you hold is never going to look good
Yeah.
because time value of money. And so if you're not trying to trade out of it in 5 years, then it's like, okay, what is the total like return on that? And so those people can really feel convicted about a location or something like that and make those investments, and it's their money, they can do that. When you're raising money, like we talked about a few minutes ago, like what gets an investor excited? Like
Yeah.
what's the emotion that gets an investor excited about a deal? And it's the numbers, it's the story, it's all of that. And then if you have a fund, it's like, okay, how am I diversifying? Like maybe I can take a little bit lower. Like I know there's a specific deal you and I have talked about that. Like if we had a fund, I am very convicted about the location. I'm very convicted about product, but it was like 1 percentage point below kind of like our threshold for
Yeah.
what we're going to do. But if we have a fund where I can average that out over across
Hmm.
5 properties, I feel that it's very accretive to our portfolio because it
Yeah.
allows us to get scale in certain areas and efficiencies in other ways. And so I think that different investment theses have kind of created some of the distortion we're still getting in the market where maybe there's a deal we really like and it's like five people are all at that price, and then it's
There's
like,
one property, in a MSA that kind of like fits a certain criteria, but there may not be a ton of buyers, but there's enough. And
yeah,
if one is solving for a tax, a tax solution, or if they're looking for a low return, or they want a low leverage, you know, it's just going to be tough to compete if you're solving for traditional, private equity syndicated real estate returns. Again, the 2x over 5 years.
yeah,
It's tough and cash flow long to boot.
and that's something, and it only takes. It's not like a stock price where there's tons of stocks and people can kind of all fight over
Yeah.
many different stocks.
Yeah.
It takes one buyer.
Yeah.
It takes one
Yeah.
buyer that needs to solve for that.
And it's not exactly the most exciting time to bring a deal to market.
No.
I mean, some properties have done really well. You've owned them for a long time. Sure, recycle the capital, but like, from our perspective, like there are some properties that we wouldn't mind trading out of because investors are like, hey, we've owned this for a while. Can we return some capital? And it's like, well, if we can get a price, but just we very confident prices are going to be better in a couple of years. We certainly could be wrong, but I think both of us that feel that way.
I
Whether
would,
we
definitely.
continue to grow NOI and get a better price, or we get some cap rate compression over time, the market normalizes, and because I think everyone would acknowledge that the market right now isn't normal,
I would
and
agree.
that we're in some range of the trough. We're certainly not at the peak. We don't know where we are on the spectrum, but we're certainly in before pre-recovery or just starting to get into recovery. Back just real quick, like, why people are buying and solving for different problems. You mentioned a store value. Is multifamily a good store value? And talk about it relative to maybe gold. Obviously, cash isn't a great store value. But then even like Bitcoin. or any other sort of store of value. But is that, do you think of multifamily real estate as a store of value, or
It can be. I don't think of it necessarily as a store of value, but I mean, I do think of it as a store of value relative to operations. I mean, we've seen it here locally. There's a developer who has done. They're going on their third project here locally, where very very high net worth family, and they are treating it as a store of value, but they have a store of value for the real estate, and then they own the opco that runs everything, and there's some of the nicest properties in the area.
Yeah.
Everyone's very enamored with what they do, and for them it works.
and then a lot of that's time frame also. 'Cause
Yeah.
if you have if you're working off of a multi-decade time frame versus 2 5 years, you can make some very different decisions.
Exactly. And like you can build that, you can make that a little bit nicer on the front end. You can invest a little bit more on that construction cost, as opposed to, hey, I need to build this as efficiently as possible so I can get out before my construction loan expires. But if you're going to build it and own it for 20 years, you understand that you want your opco to have as little issues with maintenance as possible. So you're going to spend that extra $5,000 a unit on the front end to make this decision here and make that decision there. So that way you save however many thousands of dollars in future years.
Yeah, it'd be nice if they decided they wanted to sell something. It'd be nice to buy a property up by Keystone. One piece of margin of safety, and this is a really good lesson that I think that it was kind of drilled into me when I was starting to get into investing, and especially multifamily. And it's this idea of you're chasing of risk over return, and the emphasis the emphasis of avoiding loss is more important than chasing high returns. And often when we are, raising money for projects, we got to hit a certain return, and so you feel like you're incentivized to chase some high returns because investors are like, do they get excited? They want it. Everyone sure wants to hit something out of the park, but as a point of the book, one wrong bet and one wrong investment can wipe out all of those gains.
Well, and I think of it this way, like the math equation, I think you and I talked about before. A 50% loss of equity on a deal means that reinvestment has to return 100x,
Yeah.
or 100%, 1x of what you had. And so a smaller decline makes a much harder increase on the back end.
Yeah.
And so, like, when you think about like what it takes to recover from bad decisions, it's like, oh yeah, I don't want to have to be, just to get back to zero, having to double my money.
Yeah, and, I think it's something that we've kind of had in the back of our head from since we started doing deals, and knowing that, like, hey, one deal that goes south is probably that's the last deal we're ever going to do, and we're out of business. In reality, especially nowadays, there's a lot of people with bad deals, and some of them are still in business, and especially big firms, deals go south not all the time, but frequently enough. And if you're in the business long enough, you're going to have a deal that goes south. But I think that having that principle is important, because it's easy to just if you don't have that, and if you're just like, well, I need to get the highest return, it's easier to take a flyer because you're just not thinking about the loss, versus I'm really trying to protect the principal here, and a loss isn't an option.
Yeah, and I think you and I have said it before, and I think that some of the people, like some of the risk we see in the market, was exacerbated by the fact that, I know I've said it when I've been on the show before, like for 10 to 15 years, no one in real estate lost money. Well, not no one, but like
Just, yeah.
very, very few. And as you said before, a bad operator failed up, like,
Yeah.
for a long time. And so it was easy to get away with bad decisions. And then we've seen some serious corrections in the last 2 to 3 years on that, where you couldn't just do that. And I think that's something that, like, as we look at this in real estate, not saying people are going to get comfortable with loss again, and I never want to get comfortable with loss, but what is the sentiment of it? Like, no one thinks twice about, hey, I think back, one of my first experiences with the stock market, I remember, was the old TV show King of Queens. And I remember, like, Kevin James, his character, like, one of his buddies at work told him to buy this stock, and like he bought it, and it was like went down the day he bought it, but then he
Classic.
sold it, and then he like it went up like 10% the next day, and like it was this emotional roller coaster the whole episode. And at the end, he's like, "I'm never investing in the stock market again."
Yeah, that happens to a lot of people.
And I just that was one of my first memories of like understanding what the stock market was. Now, granted, obviously, maybe it is the good picture or not picture, but that's kind of the speculation side of it. Is like a buddy at work kind of told me, "Hey, invest in this stock," and I think from like he hated it, never wanted to get about the stock market again, but like he was okay selling that at a loss.
Yeah.
Whereas in real estate, like we talk about the developers, now these developers want to sell at a loss. Like they're like, I got to get my money out. I got to get, not just I want to move on, but like I got to get my money out.
Yeah. How much money can I get out?
Yeah,
I'll
and
take 80% of it.
And I think one thing that would, I think one thing that would be healthy in the market is seeing some of those deals that like sell for the price they should sell for. I think some of them, there have been a couple of deals that like, I think that one Hail Mary buyer came in and saved a couple of deals. So I think some people are holding out hope that that person comes for their deal. And so I think either recovery and rents and NOI getting and interest rates coming to a point where, hey, we can get out, we can just be level, or those people like understanding the loss, being willing to take it, and then the market resets and people understand kind of what the market really is.
Yeah.
Because right now I think people have an idea, but I don't think people really know what the market is because there's been enough of those kind of like.
Do you feel that it's frustrating because we know kind of where things probably should trade, but they're trading at a lower cap rate? It's interesting. We learned last week our acquisition of a property salon in Indianapolis, according to the broker that sold it to us, and they held a big industry event last week, is essentially the deal that kind of unlocked and unfroze the Indianapolis multifamily market, because there was a massive widespread of price discovery, of where maybe you could find some intrinsic value. Now we were not the first bidder on that property. Someone had bid on it and they blew out of the deal, and we came in and negotiated a lower price, but still. According to the deal brokers, there was some 20 some bids and a huge, massive spread in offers, and some people were just just lowballing the deal. We feel like we got a really good price on it. It's a great property. How do you feel about kind of unfreezing the Indianapolis multifamily market, kind of setting at least one of the first data points? And now that we've acquired another big deal in Indianapolis, there's been other transactions that have taken place. Do you feel like there's starting to be a little bit of clarity, even though it's not at the prices that we would like, but are we responsible?
It's interesting because like I feel like Solana specifically, like that was one where I felt really good about it. I think in the office we were like, okay, if we can get it at this price, it makes a lot of sense. I remember you and I, when we were in best and final, it's like, well, should we go here? And we're like, nope. And we reduced our offer.
Yeah. Yeah.
And I think it worked out. And then even on flats, I think flats, I feel very convicted about how we bought flats, and I feel really good. And then I see some of the other things that have traded in the Indianapolis Metro, and I look at it and I'm like, I'm glad we got this deal. Like, and so I do feel blessed that in some of the deals that we've won, I'm very, like, I think we were looking in areas that maybe other people were avoiding. Mm-hmm. And I think that's been very good for us. I mean, the easy thing would be us right now to be going up in Hamilton County for the 3 deals that are trying to trade up in Hamilton County right now and throwing gobs of money out there. But none of us feel good about that right now.
No, it goes against a lot of this, value investing that we're talking about. We're speculating. Now, again, there's great demographics up there, but there's better value elsewhere. I think we'd both agree there.
100%.
Kind of closing things out, I guess, how do you manage some of these emotional swings, kind of making sense of it, making big bets, investing tens of millions of dollars, hundreds of millions of dollars over the last couple of years, and in a uncertain environment, getting these deals done. They're not easy. How do you keep your head screwed on straight, or at least you appear that way most of the time?
I I think it depends, obviously, kind of where we are in the process. Obviously, if you looked at me the week before we were closing flats, I was in here the day we closed it, and I probably had eyes glazed over.
Yeah, you should. Well, you can see Jay. You actually can go to the episode. We'll link that the link below. Because when we were in the process of closing this deal, Jay was, basically sequestered in his room or his office, and I would come in there and just kind of sit there while he's just cranking through, our settlement statement and going back and forth. And once he kind of didn't have any more work you could do,
Yeah.
waiting on wire confirmations, I dragged him into the podcast studio and we did a quick episode, which was really insightful. Were able to manage it? I mean, again, you were. It was a stressful day because there was a lot of just like work to do and the amount of communication that goes on that one single day. How do you do that? And then, but again, you have to sustain yourself throughout the entire process.
I mean, for me, the front end of it is actually, I don't want to say easy, but the front end, because of like the work we do on the analysis and like when we underwrite, like you poke holes in it, our analyst puts it together, I review it, you poke holes in it, our property management team pokes holes in it, our investor servicing pokes holes in it because they know the questions that investors are going to ask. So when we put in an offer, I feel very, very good, and I feel very convicted of where we are at. As we do the raise, obviously there is like the stress of doing a raise when we're trying to raise the money and do due diligence and all of those things. Like there's a few different balls in the court. Fortunately, they're not all my responsibilities. But then, I mean, if there's any hiccup on, like, if we find something on DD, which we've been fortunate not to, like on flats, but then like we did have some hiccups with some equity. We had some hiccups with debt. Yeah. And because of how that equity was structured, obviously it directly affected our debt. Those are areas where it's like, you start to feel it because you need everything to go right.
Yeah.
And it's taking a breath and getting through everything on kind of those deals and just kind of blocking out everything else and kind of getting across the finish line. And then afterwards, like, I took a vacation the next week and I decompressed and I basically like
you went on another vacation.
Yeah. I basically shut my phone off when I was gone because I was able to kind of get away and do that. And I mean, now that I've come back, I feel much, much better. But I think the ability to kind of step away and do that was very helpful after the fact. And I remember when we did Club Meridian a few years ago, I remember I was walking laps about every hour around the building. As we were doing the equity raise, as we were doing.
Jay and I talk about if you want a weight loss plan, just do a big JV deal,
$28 million.
Yeah, and have your interest rate, the 10-year Treasury rise 100 basis points, and have to retrade while you're $1 million of non-refundable earnest money in an escrow. You'll burn some calories.
I think I lost 30 pounds during that race.
Yeah, it was insane. We both got nice and trim. Well, Jay, thanks for coming on. You'll have to come on again shortly. Hopefully, we've got a great deal to talk about at some point. If we can find one that we can make sense of.
We're trying.
We're trying. Hey, make sure if you're not a subscriber to the Great Capital YouTube channel, and especially if you're still watching at this point, do us a favor and subscribe and hit the bell icon. That way, every time we put out a video of the Gray Report or any type of video content, multifamily content, you're going to get notified. But in addition, we have the best multifamily newsletter in the industry. If you go to graycapitalllc.com/newsletter, you'll be able to sign up for the Gray Report. And again, it is a digest of all of the most up-to-date research reports, articles, data related to the multifamily industry, but also the macroeconomy, commercial real estate, residential real estate. It's amazing. At some point, I want to find a way to share the people who read the newsletter. A lot of media outlets pick up the newsletter. A lot of industry media outlets read the newsletter. Top developers, owners, investors, a lot of industry insiders. It's humbling to see who reads it. It gets sent out to about 16,000 people every single week. It goes out every Thursday. So again, graycapitalllc.com/newsletter. Check it out. And if you are an accredited investor, you can hop on the Gray Capital website, click around, press some buttons, sign up for our portal, and you'll be notified for our next deal. But you got to be accredited investor because the SEC don't really trust you with your own money, unfortunately. So, okay. Well, Jay, thanks again. We'll catch you on the next episode of the Gray Report.
Thank you.